Good morning, everyone. Thanks for joining us today on the Daily Huddle for Money and Mindset Mondays. My name is Kimberly. I'm your host today. Zach is unavailable. He is still traveling, so he will be back next week, and I'll make him speak completely. Just kidding. But anyway, so thanks for joining us. If you're tuning in on YouTube, then thanks for joining us as well. But we're going to talk about a hot topic today. It's what is the bank on yourself concept? And is it good for me? We hear this quite a bit, and I laugh a lot of times with friends of ours and just people in the industry about, TikTok is where everyone's getting their financial advice now and these 30-second blips. And a lot of it is great, and there are a lot of interesting moments, but then we obviously have to dig deep, right? And to figure it out and to understand all of the other pieces that go behind that. So I want to have a little longer conversation with you guys today about the bank on yourself concept and what it looks like. So what does that mean? I've heard it called the bank on yourself concept. I've heard it called infinity banking. But ultimately, it is using cash value life insurance to fund big purchases, retirement plans, college funding, anything like that you can think of. And the reason that they use life insurance is because of the tax benefits of life insurance. So let's have that conversation first. A 401k or an IRA, something like that, those are qualified plans, right? And in those plans, you've got pre-tax money going in, meaning that it hasn't been taxed. It comes out of your paycheck. It grows tax deferred, meaning you haven't paid taxes on it. And then when you pull it out at the end of the day, you pay taxes as ordinary income. In the life insurance plans, very similarly to a Roth, right? If you guys are familiar with the Roth concept, it is after tax dollars going in, so it's already been taxed. It grows tax deferred, and as long as you follow the rules of the policy, you have complete tax-free access on the back end. Why would you use that instead of a Roth? Depends, right? It depends on the person. It depends on their strategies, depends on what they're looking for. But a lot of times, a Roth is capped. I think it might be $7,000 a year now, how much you can put in. So sometimes people want to invest more than that, right? Sometimes people can't invest in a Roth because they make too much money. So that's when cash value life insurance comes in, and we talk about that and how that works. So again, it's after tax dollars going in. It's growing tax deferred. And as long as we follow the rules on the policy and we don't overfund it and we don't pull it all out, then we can access that money tax free, which is a big deal. And we also access it in the form of loans, right? So that's why life insurance is a tax-free strategy, because when that money comes out, it comes out in the form of a policy loan, and loans aren't taxable, right, as income. Think about your mortgage. If you do a cash out refinance on your house and you pull $200,000 of equity out, that is not a taxable event for you, at least at this moment, right? Because it's considered a loan, not income. Exactly the same way for life insurance. So what are the advantages of cash value life insurance and that bank on yourself concept and that infinity banking concept? Like, why is that a good strategy that people are interested in? First of all, before we talk about that, I want to talk about the types of policies that we can use for those strategies, right? Like, what can we use? What does that look like? A lot of times you'll hear people talk about whole life insurance, and they're using whole life insurance to fund these cash value policies. But you can also use index universal life insurance, variable universal life insurance, a lot of different types of permanent life insurance policies. The question is how they're structured and how they handle what your goals are and what you're putting in. Most often for us personally, we use index universal life. So that's what we're going to talk about today. But on an index universal life policy, how does that work? Why would that be a good strategy for the bank on yourself concept? First of all, you have a floor, right? And that floor says that you can never lose the money that you put into that policy, right? So you've got that guaranteed floor. And every single year when that policy it hopefully makes money, if it makes money that year, that floor is reset. So you have some guarantee. I don't like the word guarantee, but you have some stability there, right? And you have some protection against your assets. You also have more predictable growth on the cash value policies. There are historical look backs that we can look back and see how that money is growing. But typically we are tracking an index. We are not actually invested in the market. So that's an important thing to learn as well. We've talked about the tax benefits, having access. I say this to a lot of people all the time, but if I've got $1 million in my 401k, how much money do I have? The answer is I don't know, right? It depends. It depends on what the taxes are at that point in time when I want to access my money. If I've got $1 million in my life insurance policy, I've got $1 million that I can access in my life insurance policy. So I do know how much I have there, right? So having the ability to access that and pull that out is a really big deal. And then also financial control. With IULs specifically, maybe not with some of the other policies out there, but it is a flexible premium life insurance policy. So of course, when we first sit down and structure it for your goals and for where you are currently, that's the plan that we want to stick with. But sometimes life happens, right? And you're like, I can't pay this right now. I need a couple of months off. And in IUL, you have the ability to have those flexible premiums. Or if you say, hey, instead of paying this monthly, now I want to pay this annually because my income's changed, you can do so. And sometimes, depending on how it's structured, you have the ability to put more money into that policy and allow that to grow. So the flexibility of that gives you control over your money. It allows you, to finance big purchases, things like that. And it just gives you the flexibility that you need in life, right? But it also has protection security. So we talked about the guaranteed floor, and the fact that there are no losses in this policy, as far as investment risk and things like that. But we also have life insurance, right? So it has that guaranteed plan completion component in it. So these are my goals. These are my dreams. This is for my family. But if something happens to me, then I know that it can be self-completing because we've got that death benefit that will pass to my family at that point in time and help them take care of any, financial needs or future needs that they might have had. So lots of benefits behind the cash value life insurance piece, the bank on yourself piece, the infinity banking piece. What are some of the potential drawbacks? Why would it maybe not be interesting to me? Why would, might not work for me? Well, first of all, there are life insurance premiums, right, that are required to be paid because first and foremost, you're purchasing a death benefit. So is that, are you insurable? How's your health? If you aren't insurable or you don't have great health and the cost of insurance is significant, then maybe that isn't the best option for you, right? But a lot of times when we talk about the cost of premiums, to me, the question is if the cost of life insurance is cheaper or even the same as the amount of taxes you'd have to pay on the money, it makes sense to me because we get the death benefit too, right? So you have to look at that and you have to figure it all out. What are other potential drawbacks and considerations? I think liquidity, right? And access to your money. How quickly do you want to reach some of this money? So I talk with real estate investors all the time and they love the bank on yourself concept. They want to dump a bunch of money in this policy. Then they want to take a policy loan. A lot of times those are wash loans, so you're not paying anything for them. And they want to go out and they want to buy real estate. They don't want to ask a bank if they're qualified or if it's possible or whatever. They just want to take it from themselves. And then when they sell that property or flip that property or whatever they do, they want to pay back that policy loan and have the ability to continue to do so on that tax-free basis. That's great and all, but most people don't have the big lump sum to do that up front, truthfully, right? So in order to be your own bank, you have to have enough money to actually be a bank, right? Or you have to have time to allow that money to grow so then you can be your own bank. Then you can borrow from yourself and do things like that. In the beginning, on all of these policies, you're going to have a limit on the liquidity that you can access, right? So if I dump $10,000 in today, I can't just pull $10,000 out tomorrow because there are surrenders and penalties and things like that. And it also just doesn't work that way. So I have to make sure that I have enough money first and foremost to be my own bank. And then I have to make sure that I have enough time to wait until I can access the money that is inside that policy that I want to use. So I have time to allow that cash value to build and to grow. And then opportunity cost, right? Like, what if I want to use this bank on yourself concept to buy a real estate property? I dump all this money in and I can't quite get it back out yet, and I find the perfect property. There's that opportunity cost, right? That says, hey, maybe you can't do this now. And then also suitability. We've talked about that before. I would tell you, rule of thumb in the industry, or rule of thumb in our world, is if we're using this as a monthly investment, right, where people are putting money in systematically, and they're looking to grow that nest egg over a period of time. To me, rule of thumb is to take your age and add a zero. And if you can't at least, at minimum, add that much money on a monthly basis, you shouldn't do this policy, right? Because you're paying for your money isn't going to grow the way you want it to grow. If we're just using it for a death benefit, if we're just using it for minimal cash value growth, that's different. But if we're using it for a bank on yourself policy, for a retirement income stream, for infinity banking, you got to have enough money to be able to put in there to allow it to grow, to actually use those concepts. And I think that's where, a lot of times in the past, that's what, when I talk to people, they love this concept. They love the ability to borrow from themselves instead of a bank, and they'd rather pay themselves the 5, 6, 7, 8%, whatever a bank would be charging them at this moment, and allow that to grow and compound in their bank than to borrow it from somebody else's bank. But the problem is when people say that that's what they want to do, and then I ask them how much they can afford to set aside. They say $300 a month. Okay, well, you're 50 years old. First of all, you got $300 a month to set aside. That doesn't work anyway, right? Because we're not putting at least 500 in, right? But also you want in a year, you want to be able to pull out $50,000 to go put a down payment on a house. Well, if I put $300 a month in for 2 years, that's not anywhere close to 50,000, nor does typically my return gonna make that much money in that short of a period of time. So while the concept is great and it makes sense, a lot of people don't put the reality to that, right? So I talk to people all the time and say it's sexy money, right? It's a sexy concept, but does it really work for you? And there are a lot of questions and conversations to have, with your clients, with your people, when you're having these conversations. So, is this strategy right for you? I don't know. It depends. You've got to evaluate the concept, right? And how it aligns with your different financial goals, whether it's retirement or education funding or business financing. I think for me, in reality, a policy like this is very, very, very useful for college funding. Think it's very useful for retirement planning as long as we have enough time to allow that to grow. I don't see it used as often for the bank on yourself concept and the infinity banking concept, like we hear, because people don't have the lump sum money to dump in up front, right? But I do think it's a fantastic strategy that if we're investing over the long term and I want to pull money out for my kids' college education, now I've got the lump sum and the growth to be able to do that. In my opinion, I would use this rather than a 529. A 529 counts against your kid, right? For any other financial aid that they have and anything that they need from a college perspective. Life insurance doesn't. So when you're filling out that FAFSA form, which is, I don't know what it's called, but anyway, the form you have to fill out when you go to college and your kids are going to college, and you have to see if they get any sort of grants or scholarships or anything, whether it's merit-based or need-based, you have to fill out that form. A cash value life insurance policy is not included in your money assets, right? Like they know it's there, but they don't count it against you. A 529 plan is. What if your kid doesn't go to college? I've had several friends through the years that have dumped tons of money in 529 plans and their kids don't go to college. So can it be used later? Yes. And there's some provisions in place, but you lose a lot of the benefits of putting that money in that 529 plan. So I like the non-handcuffs, if you will, of the life insurance policy, where I can use it how I choose to use it, not just for college funding or whatever. I also love it for that retirement income stream. We talk a lot of times about how do we invest our money? And there are three rules, right? First is free money, right? I want to take all the free money anybody's ever going to give me. I want all of it, right? If you guys want to give me free money, I'll take it. So just put it in the chat and start. I'll send you my Venmo, right? You can give me all your free money. The second one is tax-free money. The rest of my money I want to have with as little tax as possible. And then the third is taxable money. And it should be in that order. In reality, people are probably going to have some of each of that. When we talk about free money, that's like our 401k, right? I work with a company. They're going to give me a 3% match. If I put in 3%, they give me 3%. I want every penny of that free money, right? But I probably don't want to put 10% in to get 3% because it's the tax conversation at the end of the day that's going to be an issue, right? So what do I do with that 7% difference that I do want to save? In my opinion, I think cash value life insurance is a great option and a great strategy for that, and allow that money to grow and compound. And that way in retirement, you've got your taxable income stream from your free money, right? From your 401ks, 403bs, things like that. You've got your tax-free money from your cash value life insurance policy, and you probably have some taxable money in a brokerage account or a money market account or something like that as well. So you have that liquidity, and those are some of the rules, right? So what other things to consider? Life stages, right? Like how old are you? If you're 60 years old and you want to retire in 5 years, unless you have a significant amount of money and you want to use this as a retirement income stream, it probably doesn't make sense, right? Probably isn't going to do what you want it to do. On the flip side, if you're 20, 25, 30, 35, and you've got time before you retire, because time matters, and you have the ability to fund it, I think it could be a great supplemental piece for you. And then also health, right? How's your health? If your health isn't perfect, or you've got some diagnoses or medical issues, then might not be the best strategy for you. Or, there's a thing where you can borrow someone else's life. So, let's just use my family as an example. You have Zach and I, we've got 4 daughters. Two of our daughters are older now and in college and grad school. And if our health was poor, and we didn't qualify for a life insurance policy, but I really wanted that concept, I could put a life insurance policy on my daughter. I could put a life insurance policy on Emma, right? I could be the owner and she could be the insured because I have an insurable interest in her, right? And I could still use it with that same concept. So maybe it makes sense. The key, I think, with all of these conversations is when you start talking with people about this, when you see your TikToks, right? When you see your 30-second blurbs and you're like, oh, wow, that caught my attention. I'm super interested in this. Dive deeper. Make sure that whoever you're talking about understands the ins and outs of these policies and understands how to structure these policies. When they're structured properly, they are fantastic and amazing. When they aren't structured properly, they aren't, right? Because you've got the cost of insurance. And I've seen both in the 20 plus years that Zach and I have been in this world. I've seen both. And then risk tolerance, right? We have to talk about our risk tolerance and how it fits in with our overall strategy. I by no means think that people should take all of their investable assets and put it in life insurance, because you do have the liquidity risk, right? You do have some cost to that. So we have to make sure that there's a balance in everything that we do and everything that we suggest. And then finally, I'll say again, as I said a minute ago, policy design is key. Make sure whoever you're meeting with, ideally it's myself or Zach, But regardless, make sure whoever you're meeting with to ask these questions, they're designing the policy in your benefit. So the way we typically structure this is minimum face amount, maximum cash value. What does that mean? That means minimum death benefit, maximum cash accumulation. That's my goal with these policies. That means that, and the government sets these rules, right? Like how much money can I put into a policy and what's the least amount of insurance I have to buy to continue to keep it in this tax-free, strategy that I want to use it as. So that's the way we structure it, right? The least amount of death benefit to hold the most amount of money. If you think about it, like if you had a glass, when you put that money in that glass, if you overflow it, right? If that water overflows a glass, or if that money overflows your glass, that's when it becomes a taxable event. That's when it becomes what's called a modified endowment contract. We don't want that to happen. That's not the goal behind what we're doing. So we want our glass big enough, or our death benefit big enough, right, to hold the amount of money we put in. But if we have a huge glass and we're not filling it up, right, with the cash that we're putting in, now I'm just paying for too much insurance. And I don't know if any of that makes any sense to you guys, but those are things that you'd want to consider. Those are things that you want to look at. Those are things that when we say when structured properly, we mean. Good news is we have software that does all of that for us, but we can, run it a million different ways. Do we want to put a certain amount of month in per month and then add more later, or do we just want to max fund it forever and never have the ability to be flexible? It just depends. And then finally, I will say monitoring and adjusting. It is very important to meet with your financial advisor, whoever's helping you with these plans, at least once a year, just to check in. It doesn't have to be a long, in-depth conversation, but it's important to, like, we know more about this than our clients do because we do it every single day. So it's important for those reminders and to just say, hey, remember, this is how it works. Let's look at our investment options. Is this performing the way we want it to perform? Can you still afford it? Do you want to have more, money that you want to set aside in here? What are your goals? Do they change? So it's important to monitor it and to make those adjustments on an annual basis, because life does change. Nothing is the same from the day we start. So I hope you guys have some questions. If not, I can probably talk about this for another few hours if you'd like for me to. But I'm going to pause for a minute and, answer your questions, or let's have a dialogue. So anybody want to chat with me since Zach ditched me again? I'm just kidding. Hey, Sorrel.
You mentioned maximum cash value, minimum death benefit. And the thing that comes to mind is that, this is not an insurance policy for the purpose of the death benefit. It's an insurance policy for the purpose of maximizing cash so I can bank on myself.
Correct.
What are the typical ratios allowed or by the IRS?
I don't know the exact percentages. I'm sure that it's out there, right? And somebody, maybe Zach could give you the actual numbers. I can tell you that my software does that for you, and that there's literally a button that says I want minimum face amount, and face amount means death benefit, maximum cash value, and it allows me to do that. So if you said, Kimberly, I want to put $1,000 a month away into this policy, then I would go in, I'd put your name, your birth date information. I would put $1,000 a month there. And then I would choose that button that says minimum face amount, maximum cash value. And that software program would create the death benefit need based on those governmental guidelines, right? That says, if you want to consistently do $1,000 a month forever, or for the next 20 years, or whatever that looks like, then we have to have at least this death benefit. And then that's how that works, if that makes sense. Because we want to pay for the least amount of insurance that we have to, because insurance is a cost, right?
Yeah.
And it goes against our growth, but it's necessary because that cost keeps that policy tax free. So yes, it is a life insurance policy designed for that cash value growth. And typically people use it not necessarily for the death benefit, but for the tax strategies behind it. But the death benefit is necessary too. If you don't have the qualifications to have a death benefit, then you're not going to get the life insurance, right? The life insurance
Yeah.
company, like if you came in, and you wouldn't do this anyway because it costs way too much money, but if you came in and said, hey, I want a $3 million permanent policy and I want to dump as much money in there as possible, unless you were loaded, like legitimately loaded, like millions, you wouldn't do that anyway because you couldn't get enough money in there to make that make sense. But the life insurance company is going to look at your financial situation and say, does he really need a $3 million death benefit? Like, does he qualify for that? Does that make sense? So that's a
Mhm.
financial qualification as well. So anyway, and I think the beauty behind it is a death benefit too. So if something does happen, it does go to
Yeah.
your beneficiaries, right? And it also has the perks of the policies that we only sell, which are the living benefits that will
Yeah.
cover you in case of heart attack, stroke, cancer, something like that. Typically, when we write a policy like this, it is designed for the cash accumulation, right? Retirement funding, or fund investment properties down the road, or kids' college education, something like that. So I like to write a term policy as well. Term is super cheap, right? 20-year term, 30-year term, depending on where you are in your life. But a term is typically going to be cheaper than a permanent policy, and it covers that death benefit need. But it also allows you to pull living benefits if you had a diagnosis from a policy that has no cash value, because our goal is for you to live and live out your dreams, right? So
Yeah.
we don't want to affect the cash value of your permanent policy if you had a qualifying event. Long answer.
Thank you, Kimberly. That makes sense. So it's not me, the policyholder, who determines that ratio.
Correct. It is the
Yeah.
software. And I think that's a big problem that a lot of people, they hear these concepts and they love them and they get so excited and they call me and they're like, I want one of those bank on yourself policies. I'm like, okay, great, let's talk about it. And they're like, well, what's it going to cost me? It's not really designed that way, right? Like I can
Yeah.
say, hey, put in $250 a month, but the question is, what are your goals? What do you want this policy to do? And how much can you afford to set aside to reach those goals? And then we'll
Yeah.
design that policy and show you what that looks like. So I
And
think
to
that's an
actually
important
reach
thing.
that point takes some time. You don't buy such a policy and all of a sudden tomorrow you're your own bank.
Correct. Yes, it takes time. And even if you did, what if you had $300,000 to dump into a life insurance policy? Could you do that and could you borrow from it immediately? Yeah. And you would have the tax benefits on that. But why would you do so? Why would you pay cost of insurance if you don't have to? So to me, it is a longer term strategy. I will tell you the answer to that in IUL specifically. Why you might do that is because we like to use participating loans. And in an
Mhm.
IUL, a participating loan means that that loan, as far as the growth of the policy, never leaves the account, right? So we're earning interest on that 300,000, even though I borrowed from it, right? So that might be a reason, but it's still a conversation, right? It's still an evaluation. And I think it matters. Whoever you talk to, you need to make sure that they're educated, and you need to make sure that you understand what you're asking, and that you can afford to properly fund it. Because if you can't, then you're just buying a really expensive life insurance policy, which is great for your beneficiaries, but it's not great for your cash accumulation, what you think you're going to use it for.
Yeah. Thank you, Kimberly.
You're welcome. Any other quick questions before we close out for the day? All all these people love to talk about life insurance, right?
Mm.
Um, all right. Well, thank you for joining us again for Money Monday. Zach, I promise, will be back next week, so he can talk with me, or maybe I just won't talk and I'll just look at him and let him talk. But reminder for all of you guys: if you don't subscribe to us on YouTube, do go like us and subscribe to the Daily Huddle on YouTube. And before we close out today, I want to end with our 8 tenets. So remember to love, laugh out loud, stress less, because we want you to live for a really long time, eat mostly plant-based, take care of your body, give, sleep, move, and then finally take that pause between stimulus and response. We want you to check yourself before you wreck yourself. Thanks again for joining us today, guys. We'll see you at the same time, same place tomorrow morning.
Rather than believe that that's
Thank you.